You're losing money even when your stocks are going up, and the most dangerous part is that you don't even realize it. The enemy isn't the market, inflation, or a sudden crash. The enemy is the person staring back at you in the mirror. Think about the last time you hit the buy button. Was it the result of a calm, structured analysis of the business and its long-term value? Or was it a rush of adrenaline triggered by social media, headlines, and the fear that you were about to miss the next big thing? That emotional split-second decision is the reason intelligent, high-income professionals still struggle financially while patient, boring investors quietly build real wealth. If you stay with me until the end of this video, I'm going to share a psychological kill switch used by professional investors to shut down emotional decision-making, a tool that can save you more money than any stock tip ever will. But first, you need to understand what I call the Alex paradox. Imagine Alex, a highly skilled engineer who understands complex systems but consistently fails the simplest test of investing, the ability to do nothing. Alex sees a breaking headline, a chart moving straight up, or a TikTok expert promising massive returns, and suddenly logic disappears. He doesn't buy because the business is exceptional. He buys because staying out feels unbearable. This is emotional arbitrage, the process through which the market transfers money from the impatient to the disciplined. Most people believe they lose money because of market crashes or recessions, but the data tells a different story. The average investor underperforms the S&P 500 by a wide margin, not because they lack intelligence, but because they buy late and sell early. Their brain evolved to react to immediate threats, not to manage long-term capital. You're not bad with money. You're human. But in a system powered by compounding, unmanaged emotions are extremely expensive. This is wealth blueprint. And if you're tired of the constant noise, hype, and anxiety that comes from checking your portfolio every few minutes, you should subscribe right now. Because what comes next, the 3 guardrails of wealth, is what separates people who build financial freedom from those who retire with regret. The first guardrail is understanding that hype is a vacuum. It removes future returns before you ever invest. By the time an asset is trending on social media or dominating mainstream news, institutional investors have already positioned themselves or exited. At that point, you're not early. You're the exit liquidity, so how do you stop reacting? How do you look at a chart that's exploding upward and feel nothing? It begins with a strategy-first mindset. Before you invest a single dollar, you must define your exit logic. If you don't clearly understand why you're buying, you'll never know when to sell. And if you don't know when to sell, the market will make that decision for you, usually at the worst possible time. Price movement without a broken thesis is noise. A broken thesis, regardless of price, is a reason to exit. The second guardrail is the automation of willpower. Willpower is limited, and it's weakest late at night or during sudden market volatility. Professional investors don't rely on motivation or discipline in the moment. They rely on systems. Rules act as guardrails for emotion. Rules like a mandatory 24-hour waiting period before entering a position, or the broken thesis rule. If the original reason for owning an asset is still valid, short-term volatility doesn't matter. If that reason no longer exists, you exit, without debate. This leads to one of the hardest truths in investing. Missing out is actually your competitive advantage. In a culture obsessed with speed and hype, the investor who is comfortable ignoring most opportunities is the one who captures the few that truly matter. You must develop JOMO, the joy of missing out. Every time a meme stock or hype trade takes off and you stay committed to your long-term strategy, you're not losing. You're protecting your future. This is the wealth kill switch. The realization that your portfolio is not a reflection of your intelligence, it's a reflection of your temperament. As Warren Buffett famously said, the stock market is a device for transferring money from the active to the patient. So ask yourself honestly, have you ever panic sold? Have you ever bought because of a feeling rather than a plan? If you have, you're not broken, but you are at a decision point. You can remain a reactive investor, controlled by headlines and volatility, or you can become a deliberate architect of your financial future. Comment, stay calm if you're ready to stop chasing momentum and start building lasting wealth. And don't share this video with everyone. Share it with the one person you know who's stressed, constantly refreshing their brokerage app, and emotionally exhausted by the market. They don't need another stock tip. They need perspective. The market doesn't care about your emotions, your income, or your goals. It's a cold, mathematical system. To benefit from it, you must approach it systematically. In the next video, we'll break down the exact rules of engagement, including the 5-question filter I use before every investment decision. Turn on notifications. Stay patient, stay disciplined, and most importantly, stay human. But keep your emotions out of your investment decisions. I'll see you in the next one, where we break down the math behind why boring consistently outperforms exciting over time.